gonna share my screen. There we go. And I'm just pin that up at the top. Excellent.
All right, well, welcome everyone to the Smith Maneuver. Pay off your mortgage faster. So we are here tonight with Stef Edwards, and Christina unfortunately isn't here right now, but Stef is gonna host this presentation for us. And I'm really excited. This strategy has been around for a very long time. We have been using it with our clients for a long time, and it's kind of just coming, it's one of those strategies that's kind of come back, I want to say in vogue, but I don't know, things like kind of have their fads. And I remember this was really popular back in the early 2000s, and kind of, I think trickled away. We went through a few economic craziness over the last 20 years, but it's kind of like coming back. And you know what, it's always been there, and people have kind of taken their own forms to it. So I'm just excited for Stef to get into the details, the nitty-gritty about this. So I want to start off by saying I'm Lisa Elle. Thank you so much for joining us tonight. I am the owner of Elements Financial Group. I'm a certified financial planner, and I've been doing this for over 22 years. I have a great team of women who work with me, with our clients. We do everything related to financial planning. So I have an independent financial services boutique firm. And basically we do everything from taxes, estate planning, insurance, investments, full financial planning, retirement planning, pensions, you name it. If it's related to your money, we are pretty much handling it. And that is what we do for our clients. And then Stef, and I'll get her to introduce herself, comes in with a beautiful piece where she is complementary to me and my business, as in setting up the Smith Maneuver, doing mortgages, lending, etc. So Stef, take it away.
Amazing. Thank you, Lisa. So thanks everybody for taking some time, out of your evening, your busy schedules, to be able to invest time into actually, learning about more advanced mortgage strategies. So that's amazing. So thank you so much for doing that. You guys, Lisa, you guys can hear me?
Yes, I can.
Yeah.
So.
Okay, perfect. So I am a mortgage agent, and basically our company, In Debt on Purpose, is really strategic mortgage advice for wealth creation through real estate. That's really what our whole objective is. And the thing that's sort of interesting about the Smith Maneuver is I kind of came across it because I had sort of, was sort of scrolling through Instagram, like everybody does. And I saw this sort of ad, and it talked about how to pay your mortgage off faster. And I thought, oh, this is great. Obviously it's in my wheelhouse. I'm super interested in these types of topics. So of course, like, I take a look at it, I click on the link and I go through and I read it. And then I realize that this is like the same stuff that everybody has always talked about, double up your mortgage payments, make a principal payment, do bi-weekly accelerated. And I just thought, you know what, this is the same thing that everybody's talked about. But what if you don't actually have extra money? Is there a way that you can actually build your wealth and pay your mortgage off faster? And that's how I came across the Smith Maneuver. So basically, right now, like, I thought this article from the Globe and Mail was really, really interesting, because financial experts are basically saying that if you think sort of that traditional, financial planning advice is going to be the same thing that helped, you 10 years ago, 20 years ago, or helped your parents, it's not really the case now. We really feel that we have to look at other ways to kind of move the needle on our personal finance. So the two biggest expenses, Canadians face are your housing and taxes. And the thing that is alarming is the Fraser Institute, which is an independent study on public policy. They found that the average Canadian family actually spent 43% of its income in taxes in 2021. And that is alarming. And actually, we should all be alarmed at that, because that means you spent more on taxes than you did on housing, food, and clothing combined. So the whole idea is the answer is we have to seek out financial education, and in order for us to move the needle on our personal finance. And that's the thing that's really great about Lisa, is obviously she's doing that. She's trying to bring innovative strategies into her business and to her clients to kind of help us find, new ways to move the needle for us. Okay, so we're always going to put a disclaimer here. So remember, the webinar is educational purposes. We do talk about taxes. We're talking about investments, and there's a legal part of it. And again, we're not, lawyers, accountants, or financial planners. Lisa is. We're mortgage professionals. So, professional guidance in terms of the strategy, if you want to implement it, is always advised. And we work with licensed partners to implement it. So just note there that this is really just for educational purposes, right? So Christina and I are certified Smith Manoeuvre professionals, so we are able to implement the strategy, but some of the things that we talk about in terms of taxation and investments, we're always going to defer to, the professionals. And the great thing, actually, Lisa's firm, is they also do tax preparation as well. So you kind of have a bit of a good stop, like a one-stop shop there with her, because she could help you with both elements of that. So really, who is this for? So if you own your primary residence, or you're looking to purchase, or you currently own at least one income producing property, this is you. So anyone that's interested in real estate, and also, of course, if you're interested in using your existing real estate to help create wealth for you and your family's future. Okay. So tonight, what we want to achieve is really you walking away with what the heck is this Smith Manoeuvre, okay? And how is it going to assist you by paying off your mortgage and save thousands of dollars of interest over the years of you having the mortgage, okay? So we're going to talk really quickly, how does the Smith Manoeuvre work? Why is it important? And then we're going to look at some real life scenarios, okay? So, the challenge right now is that we know that everybody is paying a lot of money in terms of income. And with inflation increasing, it's also making it harder and harder for us to actually save extra money, okay? And to put extra money aside, to pay your mortgage, but also to invest in RSPs and TFSAs. And so especially with the fact that inflation has grown significantly, and particularly in the last couple of years, we're just finding that there's less and less money to be able to put aside for future savings goals. Okay, so that's a challenge that we face. So what do we need to do? So basically, we need to get rid of non-tax deductible debt, okay? So non-tax deductible debt are things like what we have used for personal consumption, okay? So personal consumption is obviously when we're buying vehicles, our own home, we're using debt to finance vacations or personal purchases. That's non-tax deductible debt. So the strategy is based around trying to get rid of the non-tax deductible debt. And the biggest one, obviously, is going to be your mortgage. Then we want to replace it with deductible debt. So tax deductible debt. So we're going to talk about the difference between those two things. And this is exactly what the Smith Manoeuvre is focused on doing. The moment we have tax deductible debt, it reduces our tax burden to the CRA, and it puts more wealth into our actual pocket. Okay. So the results of implementing the Smith Manoeuvre is that we can save years off your mortgage and also save you hundreds of thousands of dollars in paying interest in the process of doing it. Okay. So I'm just going to back up a little bit about the Smith Manoeuvre. So obviously, my last name is not Smith, so I didn't create this. It was actually developed in the 1980s by a gentleman that lived out in British Columbia, Fraser Smith, and he wrote the first book, The Smith Manoeuvre. About 7 years ago, Robinson Smith, his son, who's an accredited financial planner, revised the strategy and kind of brought it up. And there's actually a book that you can actually purchase, and we can make some available to you. Of course, and it's about 178 pages, so it's not a crazy read, but it basically breaks down the strategy for you. And so it is it's a Canadian strategy, and was developed by Canadians because they were really looking at the US partners, where, if anybody knows, in the States, you can actually deduct part of the interest off of your mortgage. And so Fraser Smith, in combination with Robinson Smith, his son, developed the strategy as a way that Canadians could actually use some of the Canadian tax law to take their mortgage and make it tax deductible. Okay, so this is what basically the process is. Okay, so it's a debt conversion process. Okay, so we talked about the difference of good debt and bad debt. Okay, so principal residence, you've got bad debt, it's the mortgage, right? So remember, you live in your house, it's personal consumption. Good debt, on the other hand, is that if you have an investment line of credit. Okay, so this little column here basically shows that we want to get the gray silo, and we want to get it down to good debt. So we want to do this debt conversion process, so that dark gray column, bad debt, is small, and good debt column for the investment line of credit is high. This is what we're able to deduct off our income, on our income taxes, and create tax savings. Okay, so it's this debt conversion process. So this is basically the Smith maneuver. Okay, so everybody, we've got your house and your primary residence, and you have your basic household bank account. Okay, so your household bank account, you pay your mortgage, right? Everybody does that every month. Okay, so then on the type of mortgage structure that you have, you pay your mortgage payment, and you also have a readvanceable line of credit. Okay, when you pay your mortgage, there's a portion of it that's principal and interest. The principal portion is new available credit that you have in the line of credit. Okay, so for example, if you pay your mortgage down if you make your mortgage payment of $2,000 a month, out of that $2,000 a month, maybe $1,000 of it is principal. You're able to use the principal of $1,000 in the line of credit as soon as the mortgage is paid. Okay, so the idea is that you would re-borrow the principal that's available on the line of credit, and you would use that, you would put it into your Smith Manoeuvre bank account. Then you would contact Lisa and you would invest that money. Okay, by doing this strategy, this and line of credit is now tax deductible, and any time that you're actually able to borrow money for the purposes of investing, okay, you are allowed to deduct the interest that you're paying. Okay, so this whole cycle of every month making your mortgage payment, using that equity that you paid down and reinvesting it, you're doing a couple things. You're getting the appreciation, obviously, on the value of your home, but you're also leveraging that equity and using it to invest into capital markets. So you're using inflation is working for you in terms of your investment returns and also the appreciation of your house. Okay, so this version is what we kind of call the plain Jane version. So people think, well, how does this actually shorten the amortization on my mortgage? Like, how does this help me? Well, it helps you this way. So this little chart here, we just pulled this up just to show you like a mortgage payment and show you that there's a portion of principal that you're always paying down on your actual mortgage. Okay, So I'm going to show you an example just to kind of illustrate exactly how this works. Okay, so we've got Kayla and Dylan, and they own their primary residence. They want to pay their mortgage off as quickly as possible, but at the same time, they want to build their retirement savings portfolio without impacting their current lifestyle. Okay, so wow, that seems kind of impossible. How can I pay my mortgage down? How can I invest money without increasing what I'm actually paying? Okay, so this is what the Smith Maneuver does. So we're assuming that the amortization is 30 years, and they are applying tax rebates that they receive from borrowing to invest. And in this particular situation, they were able to reduce their amortization down to just under 21 years, and they also increased their net worth by $320,000. Okay, so how did it work without them actually contributing any extra payments above what they're already committed to? Okay, so as I mentioned, you've got that principal that you're able to readvance on your readvanceable line of credit. It turns it into an investment loan. The interest is tax deductible. You're claiming that on your income tax every single year. You're applying your tax refunds that you're getting as a pay down onto the principal of your mortgage, whereas you would never have had that. The other thing is some of the investments that you're making, they're paying dividends. This is non-registered money. You're using any of those dividends or investment returns that you're getting. You're applying that as principal payments onto the mortgage. And that's how they were actually able to reduce their amortization. Okay. Now, at the same time, your net worth is growing because you're also reinvesting the equity out of your house. Okay. So this is what the chart actually looks like. So this is the mortgage, right? So we've got this, the mortgage didn't change. The amount of debt you have basically stays stagnant for the whole period of time. Normally, this green line here, this is the normal trajectory of you paying the mortgage off in 30 years. This line right here represents the fact that they were able to be mortgage free faster by applying the tax rebates and refunds onto their mortgage. Okay, and we're using current interest rates in this scenario. Normally what happens is when you pay down your mortgage, right, which is this green line, you've got all the equity, right? So when you first start, you've got a little bit of equity. So the equity is really the difference between the yellow line and this green line. The difference between this gets reinvested. And that is what represents this red line, right? So this is the investments that are growing, the investment portfolio. And the reason why we say you have a net worth of $320,000 is because we have to deduct the investment loan, right? Which is, you know, basically the mortgage balance. So that's why we have a net worth of 320. So if you were just paying your mortgage off, not readvancing the equity out of your home and just paying the mortgage off every month, you'd end up, yes, mortgage free, but you wouldn't have an investment portfolio of $820,000. So in this particular case, you still have all the value in your home. You have an investment portfolio worth $820,000, net an extra $320 that you have that you wouldn't have had normally, and you also shaved off about 9 years off of the mortgage by implementing this strategy. Okay. So again, the biggest issue with, you know, Canadian homeowners is that they really are forced to have longer and longer amortizations. And that when we have such a long amortization, we are paying so much interest to the lender, right? Because we have to take it over 30 years. And, you know, if I just go back to this one slide, when you look at how much income you have to, what you have to actually pay and you have to earn in order to be able to pay your mortgage, it's you have to earn $1.7 million just to pay the mortgage. And that's net after taxes. So it's a huge amount of our income that we're actually paying for just a mortgage. And there's so many other more useful, better things we could be doing with that money. So if you can use the strategy to reduce your amortization at the same time build a nest egg for yourself, it's a win-win situation. Okay, so this talks a little bit about using a rental property and how you can use a rental property to reduce your own personal mortgage. Okay, so if anybody has a rental property, this is sort of the normal situation of what happens. Okay, so you get a rental income, it goes into your household account, and you make the regular mortgage payment. Okay. Now, when you've got a rental property, you can do anything you want with that rental income. And so this strategy represents, well, why don't you take that rental income and pay it down as a lump sum extra mortgage payment onto your own principal mortgage? Because remember, when you hold it in your personal name, it's all income. Revenue Canada doesn't care what you do with the rental income. Obviously, you're going to want to pay the rental expenses, but when you receive that money, you can flow it through your own personal residence. Okay, so if you make an extra mortgage payment, all that extra mortgage payment goes reducing the principal. You're able to re-borrow it off of the line of credit. You're going to re-borrow that principal amount, pay the rental expenses, and keep cycling through. Okay, so I'm going to look at the schedule we've got of Kyle and Dylan. So their principal residence mortgage, this is identical, same tax bracket. We haven't changed anything. We look at the annual rental expenses, and we know that annually they have about $32,000 in terms of what their rental expenses are. Okay, so now the rental income in this example, it's actually negative cash flow. Okay, so their expenses are $2,700 a month, but they're only getting $2,500 a month for the actual rental income for their property. Okay, so let's look at what it looks like with the actual numbers. So this is their regular mortgage payment. That hasn't changed. They make that. The rental property, right? We know that there's $2,500 a month that comes in rental, and we know that there's a small short fill that Kyla and Dylan are chipping in because they're negative cash flow on it. Okay, so they're going to make their extra mortgage prepayment of $2,702. They're going the $2,702. They can re-borrow it out of the line of credit. Now, because they're using the line of credit, it's an investment loan. They're using it to create income. It's an investment loan. 100% of it is tax deductible. They re-borrow the $2,702.75, and they pay the rental expenses for the property. Okay, so we know that when we go through this scenario, this was the first one with the plain Jane. We're just borrowing and reinvesting. We're not using a rental property income. When we use rental cash damming, it's significant how it improves the client situation. So the investment portfolio grows to almost 1.3 million. But the big thing is that we took a significant amount of the amortization period off of the mortgage. So we're able to convert their mortgage in less than 10 years, and they'll basically be mortgage free in 20 years. So if they decided that they want to cash out the investments, pay off the investment loan, they would do it in 20 years. And remember that originally it was going to take them 30 years to do that. And then this is very significant that look at what the investment portfolio has grown. So when we pay off at the end of the 30-year period, when they pay off the investment loan, they have over $500,000 of cash that they wouldn't have had otherwise. So people think, okay, well, is this legal? 100% it's legal. This is the actual CRA bulletin in the income tax folio about the interest tax deductibility. Okay, so remember that this whole concept is the taxpayers, we are allowed to rearrange our affairs so that borrowed money using to purchase income producing assets, right? So whether it's Lisa purchasing capital investments in the market or rental properties, you are able to use those deductions, right? Which you're able to apply as mortgage prepayment, and of course use to borrow, the whole concept of borrowing to invest. So why is this good for you? Well, obviously it improves, your financial life over the long term. It is a long-term strategy. It doesn't require any additional cash to get the benefits. You're obviously going to pay your mortgage off. And we showed you with both of those scenarios that you actually create additional wealth for yourself. So this is, and I know that we've gone over this very quickly and you're probably thinking, oh my gosh, this is crazy. This is a lot of information, and it is sort of like drinking through a fire hose as to how to sort of absorb it. So I think what we'll do is let's kind of open it up to some questions. And of course, there's always one-on-one time that we can book and do sort of a strategy call and, talk to you kind of how it actually works. So I'm just going to stop sharing for a sec, and I'm going to bring Lisa back in here. So,
That is
okay.
Awesome, Steph.
Shoot away, everybody. You're probably like, oh my God,
Yes,
what the heck was that?
Please write in the chat if you have any questions. It's amazing every time I see the strategy, and keep in mind, what Steph is showing you there is actually really, I think the investment was at 6% we talked about, right?
Yeah, 6% was the investment, and on the dividend rate of return, we used 4% on dividends, which I think is pretty conservative.
Very conservative. So these numbers that we're showing you are super conservative. They're not like pie in the sky. Oh, you're going to get 12% on your investments. No, this is 6%, totally doable for a long-term strategy, 100%, right? And when you really sit down, and I know Steph has a spreadsheet, it's really simple when you really take a look at the spreadsheet, and you can see every year, or they can really just illustrate every year and how that would grow and how your money would grow. It's really good. You can really see it at play in a nice spreadsheet over 30 years. So okay, Kim said I would totally need my hand held if I was to do
this. Yes.
That's why Steph is here and I'm here.
Yes,
that's
it is an advanced mortgage strategy, and absolutely we work very closely with you and with Lisa in order to make sure that we're implementing the strategy. So basically what happens is for clients that want to implement the strategy, we're basically getting on a call with you, for half an hour every month to make sure we're setting up the accounts and everything's flowing properly. Yeah, absolutely. Yeah.
Setting up the right mortgage, the right account,
yes,
getting your taxes done properly.
Yes.
You will get us to help you with your taxes or go to your accountant, but I'm saying you're not going to do this on TurboTax. So
yeah. No, absolutely
or
not.
Running to the corner bank or H&R Block, you're literally going to be making sure everything is checked off correctly. It's
really, really important that your financial planner, right, that they they understand how the strategy works, and at the same time that the accountant that you're working with understands as well. And that's, like I said, that's the nice thing about Lisa's firm, right, is because they have all that together. So, they know exactly what it is that you're doing. There was a really good question in there. It said, will all banks do this, type of mortgage? So you do have to have the right type of mortgage. You have to have a re-advanceable mortgage. So you need a mortgage and you need a re-advanceable line of credit, and it has to be able to rebalance on a monthly basis. Okay. So we make sure on our side is that you have the right type of mortgage set up. And it may mean that you do not have to exit your existing mortgage. You may already have the right setup and you just need somebody to help you implement the actual strategy. So.
Right. And Krista mentioned, she said, if you know some of the banks which practice this method, and this is a HELOC, but the management of funds to invest will be managed by Lisa. So yeah, basically in a nutshell, yeah, there's the line of credit component on the readvanceable mortgage, right?
Yes.
So,
yeah. So basically how we would work is like, in that, example where we had the chart up with the mortgage payment, if, $685 is available as principal repayment, when we go through the calculations with you, we figure out how much you're actually able to readvance and how much you're going to be able to use to invest. Okay. So because we don't want any extra cash flow requirements from you, when we do the withdrawal for the investment, even though there's $691 available in the line of credit to invest, we need to leave money in there to pay the interest on the readvanceable line of credit. So, maybe we're going to tell Lisa, hey, we only want you to take $650 out to invest each month, right? So the actual orchestrating of moving the money, we have advanced calculators that we're actually able to figure out exactly what your number is. So.
yeah. And the other thing I want to see too, what's really important, and I don't think I can stress this enough, this is for anyone who's investing, and that is dollar cost averaging into the market. When you do this strategy, you are literally dummy proofing, like it's like you're dummy proofing your financial plan, because when you can invest systematically, and if given the opportunity, the people who do the best in investing in any mutual fund, any like stock, anything, period, is when you can invest periodically, like monthly, into the market. You are buying as the market cycles high and low. So you're going through all those market cycles and you're buying little bits every month, more units every month. So that, just so you know, strategically over time, that has typically netted most investors an actual higher return than just buying once and setting it and forgetting it. So you want to be doing that, because there's like a really good chance you're going to be in a very positive return, and actually do better, up to like 1 or 2% on average better. Like they have studies on this, you can go look it up, I can look it up for you, but you're going to honestly do a few percent higher than just if you dump in once, versus like actually buying through all the different market cycles. And keep in mind, this is going on for like years. So this is not like, you're not just buying into the market once today, you're buying in over the next 20 years every single month. So like from an investment standpoint, that is why like a 6% return is very, very doable. So
yeah, Krista had a good question there. She said, is there a monthly cost? So it is a fee for service. It's very reasonable. Of course, any fee that you do pay for any type of financial planning is tax deductible. And yes, for success, it would be ideal to have everything automated. Okay, so there's a certain amount of things you can automate. There's a couple things that have to be manual, but for the most part, it is automated. But we handhold you through that, and we help you with that process to make sure. That everything's flowing properly. So there's a good question here from Jillian. How does this change when it's time to renew your mortgage? Does it affect your timeline? That's a great question. So when you renew your mortgage, we're going to recalculate everything, because the amount of principal, it really depends on what your interest rate is, right? So if you're in a mortgage right now and you're paying 2.5%, obviously there's a larger portion that's principal that you can reinvest. When you renew the mortgage, maybe you're renewing at 6%, and then obviously there's not the same amount of principal. So this is sort of an ongoing strategy, and we're always tweaking it for you as your mortgage needs are changing. And it could also be that you may move. right? So you can still take the strategy with you from one house to another. But then again, we're just making sure that we're doing the calculations based on, the new mortgage, based on, if you've moved, and keeping all the accounting of that correctly for you. So it's just like your investments is it's like a organism. It's a living, breathing, dynamic, organism. The same thing with the Smith Maneuver strategy, right? So it's like a living, breathing kind of identity, and it's changing as interest rates are changing and lines of credit are changing and your income's increasing, tax deductions. So it's not a static, type of strategy. And so that's why there is a lot that's involved with it. And that's why obviously there is, a very reasonable fee for service in order to implement it. And if anybody on this call was thinking about buying an investment property or has an investment property, implementing the rental cash damming is like incredibly dynamic. So I just want to say something. When Lisa was talking about this idea of dollar cost averaging, investing into the market, nobody cares, honestly, if you don't do a pre-authorized investment for $500 a month, right? Nobody cares about that. But who cares if you don't make your mortgage payment? Is the bank, right? So no one is really monitoring us in terms of investing on a regular basis, okay? Which unfortunately, it's unfortunate, but we have to police ourselves, right? And you have to set up good financial habits, right? And this is something that Lisa advocates all the time. So by making it automatic and by using the equity that you've got in your home, we have to sort of change the way we think about debt. This whole idea of paying off your mortgage, and it's like you get like a badge that, it's like, oh, I have no mortgage. Great. But the wealthy have been using these types of strategies for years. So traditionally, a wealthy individual would say, I'm going to buy that house for $500,000. I'm going to pay cash for it. And then the day after it closes, I'm going to go to my lender and I'm going to take a loan out against that house for $400,000. What has happened is because they've taken that $400,000, they've taken the equity out of that house, they put it back with their investment advisor and say, now I want you to invest this because it's non-registered money. They're able to deduct the interest on the mortgage that's on that house. Okay. And if the property is free and clear, there's no tax deductibility, and that equity that they have in the home, it's not working for them, right? It's not doing anything else. So if you think about it, you have your house that's increasing in value, and you have your investment portfolio that you've given to Lisa to invest. So you have two asset classes where inflation is working for you, right? Because inflation makes things more expensive. Your investments go up in value, your house goes up in value. That's good, the good way to leverage inflation. The one thing about inflation, like, yes, food, gas, the costs are going to go up, but one thing inflation doesn't touch is it doesn't touch your mortgage. If you start with a $400,000 investment loan, it's $400,000. Inflation doesn't increase it. It stays the same and it stays static. So you have two asset classes that are growing and the debt is staying the same. And we have to get this change in our mindset that using, paying things off, right, is the way to go. And we're saying, yes, you want to make sure you have the right kind of debt. You want tax deductible debt. Use it to your advantage. The wealthy do not, create wealth by just paying everything off and sitting on an asset saying, oh, I own it all free and clear. No, they use that asset to purchase another asset for another asset for another asset. They go back in, refinance that asset, take the equity out, and they build it. So this strategy, we're not talking about leverage. We're talking about using the same amount of debt that you already committed to. You committed to a mortgage that you're going to pay it off in 25 or 30 years. We're not changing that. We're not telling you to take on more debt or to increase your mortgage. It's the same amount that you pledged that you're going to pay off. We're just moving it from one column to another column. That's it.
I love that, Steph. I have a question, and maybe this is how we'll wrap it up. Unless anyone else has any questions, throw them in the chat. But my question is, okay, so what if I want to stop doing this strategy? Can I stop at any time? Say I lose my job and say I'm like, I need to regroup in my life, or you're getting divorced. Oh, stuff happens. So is this something I'm locked into for like 30 years, or can I cut this strategy at any point?
So that's a great question. And the beauty of it is that you could stop it at any time. Okay. So you've always got those investments, and the investments, basically you could, redeem the investments, pay off whatever the investment loan is. So absolutely. So you can totally exit at any time. Now, depending on what you're invested in, right? You want to be careful, like with any investments, right? You want to make sure that if you think, oh, I'm going to try this for a couple years and then I'm going to pull out, you have to be careful about what you're investing in, right? So that's why it is a long-term strategy, right? In order to see the long-term gains. But yes, absolutely. If there's a major life event that happens, 100%, you can just redeem your investments, pay off the investment loan, and be done. And again, just remember, I'm talking about non-registered investments. You already get a tax break when you contribute to a TFSA or you contribute to an RSP, right? Because you're getting a tax deduction, and then the TFSA, you don't get a tax deduction, but it grows tax-free. But we're talking about non-registered money here, okay?
That's awesome. Okay, so our call to action is book a call with myself and Saves for the Smith Maneuver, and we'll do a joint call with me, Steph, Christina, who's not on this call tonight, but we will book it. You can book it in, reach out to my office, or you can book directly into my schedule, financialclaritycall.com, and we can get you started there. Yeah, so that's financialclaritycall.com. I have another one that's even easier to remember. It's called appointmentwithlisa.com, and we'll get you hooked into this and get a joint call going on with myself, Steph, and Christina, and just see if this can work for you and how this will benefit you and your family. So I think
I just put a little note in there that if you go to Instagram in Debt on Purpose, in our link tree, you can actually click on the link tree, and you can book a free consult. And again, of course, we can also we'll do a joint session with Lisa as well. So hopefully, and you know what, I love the fact that you guys had such great questions. And what we're going to do is we're actually going to send out a book to every person that's on this call. So what you'll need to do is just contact Lisa with your information, and then we will mail out a book. And I've got one just again right over here. So again, remember that it's not a long book, okay? It's not a beachy novel either, but it is
come
great.
on.
It's not, okay, I lied. It's 133 pages. And, the print is it's not super small. So yeah, so contact Lisa through this, and we'll make sure that everybody gets one of these books, because I think that every Canadian homeowner needs to know the strategy. And once you learn a little bit more about it and understand a little more about it, because I know it is complex to try to get all this information, then hopefully you share it with other friends and family, right? And we have to create a revolution about how we think about our mortgages, right?
Absolutely. Yeah. And I think what makes this strategy, it's not a difficult strategy, but what it is it does have moving parts, which do
Yes.
require the mortgage broker, the tax, like the accountant, the investment advisor, da 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 da. Like it's just there's moving parts, right? So you do need a team around you to help you with this. So we are here for you. And any questions? I'm so excited. Thank you so much, Steph. Thank you, everyone,
Thank
for joining
you.
us tonight. And that is the Smith Maneuver.
Wonderful.